Hello ladies and gentlemen, this is Usman Ali and I'm recording the video in reference to one of the slide of this chapter of inventory where I have recommended to watch the video and in this video I will explain what ceiling is, what floor is and what is the role of them. So you saw three names there in that slide by the name of ceiling, replacement cost and floor. Let's discuss them. You do understand what a replacement cost is. We discussed that in one of the previous slide to that it is the cost that is needed to repurchase that inventory if I'm a merchandising concern. But if I'm a manufacturing concern, then this is the cost which I need to manufacture this inventory once again. Okay, that's the replacement cost. Now there is this rule of LCM, lower the cost over market rule, will be applied on these three values. And it is said that replacement cost should be smaller than the ceiling value, or it cannot be greater than the ceiling value. Okay, and this replacement cost should be greater than the floor value, or same thing can be written as this, that ceiling, replacement cost and floor. So it is said that this replacement cost cannot be greater than ceiling, and this replacement cost cannot be smaller than floor. So both of these terms are same. If I use this one or if I use this one, they are actually same thing. They're not representing different things. Now let's explain what does this mean, that replacement cost cannot be greater than the ceiling and the replacement cost cannot be less than the floor while you are applying the LCM rule here. Now look at this, ladies and gentlemen. Let's say I have been constructing a building and a house for myself. So what I did is I incurred, let's say, this much cost. So I will write it C here. So this represents the cost which I have incurred till now. This is the ground. So this much cost is incurred till now, and my house is not complete. It means that still there are things remaining, but let's say 80% of the house is done and 20% is still remaining. The 20% which is still remaining, so let me use a different color for that. Okay, yeah, this will be fine. So the 20% which is still remaining is actually the blue color, and I would say that this is the remaining cost or manufacturing cost in a business concern, RC, not the replacement cost. Okay, this is the remaining cost. And then I have a business of property. What I actually do is I manufacture buildings like this and then I sell them. So I sell them, and I had made my mind that I will earn a particular amount of profit, which is represented by B, P for profit. So C is the cost that I have incurred till now, and 80% of the work is done on the house, 20% of the work is remaining. The blue color, which is remaining cost, is the remaining masraf or cost that I should do, okay, in order to make this building finished, and then I will sell it. When I will sell it, I will earn a particular amount of profit actually from it. So the thing is that when I want to fix the price, that on what price I will sell it, so then I'm gonna account for all of these, I'm gonna plus all of them, and this will become my selling price. Okay, so that's how we fix the selling price of our product, our inventory. In my example, it's property, business. Now, right now I'm standing here. If you remember at the start of the example I explained, right now I'm standing here. And let's say suddenly I got a Canadian immigration visa, and that's it. I'm done with my businesses in my country here, and I want to go to Canada because I want to do my further education, and it's kind of a good opportunity for my life. So the house or the construction site is not finished good yet, and I want to sell it. So that's very much obvious that if I want to sell this house, no one gonna give me this price. No one gonna give me the selling price which I have fixed, because there is still some work remaining. It's work in process actually. So I say, okay, done. I understand that no one gonna give me this selling price here. But how much of the price I will receive if I sell this construction site right now? So very simple. They will say, okay, selling price, what is your price you fixed, minus the cost which is still remaining, like manufacturing cost. If it is a manufacturing concern. If it is a merchandising concern, then we call that selling expense. These are same thing, manufacturing cost or selling expense. And in my example of property, it is the remaining construction cost. So people will say, okay, your selling price is this much, minus still more cost must be incurred. So sir, I will give you only this much money. Let's say $1 million is the total value which you have fixed, but $2 lakh worth of construction is still remaining. Okay, so it's like this. This is $1 million. And this is the $2 lakh construction is still remaining. So 1 million minus 2 lakh is equal to $8 lakh. Sir, if you want to sell this building right now, so I will give you $8 lakh, and you know the reason why. I say, okay, yeah, done. Realize it's the realizable value. If I sell it the construction site right now, so if I try to realize it, the money that I will receive will be the realizable value, which is $8 lakh, not $1 million. No one will give me $1 million. Let's think rationale. So this is the concept that what actually ceiling is. This is called ceiling. Okay, that the money that you will receive right now if you decide to sell this thing, and if this thing is not a finished good yet, so obviously it will be less. What if it is a finished good? Then yeah, you can receive whatever the selling price is. Then that selling price will be your realizable value. But if it is not a finished good, then obviously the cost that will be incurred to make it finished will be subtracted from the selling price. So I hope you got what ceiling is, or net realizable value is. So if I use the word ceiling or net realizable value, both of them are same. So that's one point is clear. Then the thing is, okay, so you got the point that net realizable value includes the cost and the profit. It does not include the manufacturing cost or selling expense or remaining cost. So this is the net realizable value. We got this point. So let's come to the second part. The second part says that the replacement cost cannot be greater than net realizable value. If you remember, we discussed it here. Replacement cost cannot be equal to the net realizable value. So let's explain this thing how. Very simple. If this profit plus cost is the net realizable value, let's say it is $8. Okay. And if I want to see that, okay, what if I buy this inventory right now from the market in the same condition which is right now, it's kind of this, okay? And let's say I explored that if right now I buy this inventory, then it cost me this much tall, this much high. Let's say this is $10. Okay, that's $10. I wanted to write here $10, but unfortunately I wrote here, okay, $10. So look at this. It means that replacement cost is higher than the net realizable value that I can receive. And according to the LCM rule, lower the cost over market rule. This is the kind of a cost thing. This is kind of the market thing. Whichever is lower. $8 is lower here. So I'm going to use the $8. That's why I say that replacement cost cannot be greater than the realizable value. Or let me put it in another way. If let's say I incurred a cost of $10 to purchase this inventory right now, and then I want to sell it, realize it. So how much money I will get? Only $8. $2 I won't get, because that $2 cannot be realized. So you can take it in both ways. So this is the reason that why replacement cost cannot be greater than the ceiling cost. So I explained two things in this page. One, what do you mean by ceiling? And the second thing is why the replacement cost cannot be greater than the ceiling. Let's go to the next part of the example, which is what do you mean by floor and why replacement cost should always, cannot be less than the floor. So let's discuss that thing. I will put a page to, okay. Now, let's do this part now. So what is floor? The formula of floor is very simple. Floor is simply net realizable value, which is called ceiling, minus the normal profit. If the times are tough, this is your cost. Then this was, if you remember, your remaining cost or manufacturing cost. And this is your profit. And the whole tower that you see was actually called as your selling price. And then there was a compromise of this manufacturing cost, and it became your net realizable value. So we got cost and we got profit only, which means this is the net realizable value. Let's say the times are tough and the market situation has gone so tough that I am not able to earn any profit, let's say. So what should be my objective then? If I cannot earn profit, don't you think so that I deserve to at least recover my cost? Yes, I do deserve to recover my cost at least. So look at this, net realizable value is this thing, okay? If I minus or I try to sacrifice that, okay, no problem, the times are tough, let me sacrifice my profit also, which is normal profit. So then this is the floor. It means at least in the normal concerns, at least I should recover my cost, because the floor is what, that's then the only thing remaining in this tower. Like, let me do it. If I subtract profit from the net realizable value, so then only the cost will be remaining here. So at least I deserve to recover my cost, at least if everything is okay, remaining things are okay. So this is what the floor is actually, that okay, at the lower end, in a very worst situation, I will sacrifice my normal profit, but still I will try to recover my cost at least. So that's what the floor is actually. Then the last part, and we are done, that replacement cost cannot be, what you say, lower than the floor actually. Yeah, it's very simple. What is the assumption here? The assumption is very simple in this floor comparing to the replacement cost. And it's quite sensible as well, that the inventory below its floor cost, and it makes so sense for the company to value its inventory below its floor or cost, and it manages to earn the normal profit. It means the assumption here is that the floor value of the company is there, and the company can still have a margin for its normal profit. So let's say if this is my floor and my replacement cost is this much, let's say, in order to prove this point that replacement cost cannot be lower than 0, so I'm giving you an example where replacement cost is 0. So if you can see, my cost is this much and my replacement cost is lower than that. So it's very simple. Even if I subtract my normal profit and I get this much cost, and if the market prices are comparatively low or the current manufacturing price is comparatively low, so that's fine, the lower value is the replacement cost. But then what I will try to do is that I will try to recover whatever I have invested in here, okay? Because the company, the value of its inventory below its floor or cost, okay, it makes sense for that, and it manages to earn normal profit because it will be in losses. So if they go even lower than that, then they will incur losses actually. If let's say they take this one, so then that's kind of a loss for them. And remember this thing, this LCM rule, ladies and gentlemen, it is applied. We are applying it today. Let's say the replacement cost is lower. It's not guaranteed that, okay, today I am adjusting on the last day of the year and I will record the lower value, the replacement value. it's possible that after 5 years the replacement cost goes even more than the cost. Then what? So it's kind of a optimal situation we are trying to find, a mid situation we are trying to find. What is this mid situation? So we have the ceiling value, we have the replacement cost value, and we have the floor value. And what we try to do here is we try to find an optimal value. We try to find the mid value of all of them. Whichever value is the mid value, that will be shifted and it will be compared to the cost. As if you remember, you see in the slides it's also given, and I will explain it here also. So the example is like this, that we got ceiling, we got replacement, and we got floor. So what happens is, from them we try to find a mid value, which you can say is designated value, and then we compare this designated value with the cost of purchase or cost of manufacturing. When we compare it, from there we get the lower value, or we apply the LCM rule to it. And okay, so if we go back to this point, that why not we are taking a lower value, because it's not guaranteed that you will sell it again before even selling it. Maybe you sell this inventory after 1 month from today, and within the 10 days after this adjustment, the prices of the inventory goes very high. So we kind of have both sides of this. It's just like if I am driving in a jungle on a road, so I don't know that from which side an animal can come out, because on both sides it's like dense jungle trees. So the safer point would be if I feel that it's like the road is quite straight and I can see that there is no opposite side vehicle is coming. So the safer technique that I can use is I can drive in the middle of the road, so that even from any side if an animal comes out, so still it would be a kind of a safer situation, and I will have plenty of time to slow down, as compared to if I'm going on one edge and suddenly animals come out. So the seconds that I will have in the second option would be comparatively less. So this is the concept of ceiling, replacement cost, and floor, and why the mid value is taken. Okay, so that's it. Thank you very much, ladies and gentlemen. Stay safe.